Hey everyone, this is Scott here again with another video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, just like what I did with my What Are Put Options video, in this one I'll be explaining exactly what call options are. And so just like I started off my What Are Put Options video, I do want to say that if you are brand new to options, I recommend you first watch my What Are Options video. I'll drop a link to that one in the description of this video here, because that one will give you a great high-level overview of just generally what options are, and more importantly, how you should exactly be understanding them. And then once you have that solid high-level overview, you can come back to this video and then learn specifically about call options, which is just one of the two types of options. And lastly, before getting started here, as always, I do want to say that if you are interested right now in taking a deep dive and learning a lot about options and options trading and stock market investing, please check out my courses on SKILLSHARE. I've been teaching on that platform for over a year at this point. SKILLSHARE is very similar to YouTube, except the content on SKILLSHARE is geared solely towards the purpose of education in the form of online classes. And in my detailed courses, you will see a lot of the research and analysis that I have done using real stock market data with spreadsheets and graphs and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I have provided some links to some of the more introductory courses of mine in the description of this video below. Now, one thing to note is you will need a premium subscription to the SKILLSHARE platform to watch my courses. But if you do sign up for that kind of membership through the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses for free. And then once your trial has ended, it's only going to cost you a few dollars a month to maintain that membership. SKILLSHARE is super affordable. You'll get a ton of value out of it. And if you decide you don't like it, you can cancel before your trial has ended and not lose a dime. So again, if you are interested, please check out those links and join the thousands of students that have already taken my classes. All right, so now diving into the core content of this video and talking specifically now about call options. And just to recap a bit here, as I've mentioned in previous videos, options as a whole, they are simply meant to be used, or they were designed initially to be used as stock insurance. You can, of course, use them to speculate and do other things in the stock market. That's one thing that I do on a daily basis. But initially, they were designed to help recuperate your losses on various stock positions that you may have in your portfolio. And so with put options, for example, and by comparison here, put options allow you to insure your long stock positions, meaning if you initially bought shares of stock at a certain price and you wanted to prevent yourself from losing money if the stock actually decreased in price, that's what put options are used for. And if you want to see a very in-depth explanation of how all that works and a demonstration with a ThinkOrSwim trading platform that I use, you can check out my What Are Put Options video. I'll drop a link to that one as well in the description of this one here. And so call options now are very similar. They're the second of the two types of options, except they're basically the opposite. They work in the opposite fashion as put options. So with puts, as I just mentioned, these kinds of options are useful if you initially bought shares of stock and you wanted to protect yourself from the stock price actually falling. And so with call options now, these help protect your various stock positions where you initially shorted shares of stock to begin with, and now you want to protect yourself from the share price actually increasing. And short selling is a bit more complicated than just buying stock, and so I'll just give you a brief introduction into what that concept is in this video here. So as opposed with buying stock and going long, and therefore you hope the stock price actually increases from where you bought it, with short selling, you're actually hoping now that once you short the stock, the price actually goes down. That is how you're going to actually profit with a short stock position. And so the way this works is you initially borrow shares, you literally borrow shares from your broker. You then immediately sell them in the market at the current market price. And hopefully if you are correct and the price actually does go down, you can then buy those shares back, return them to your broker, and make the difference in price as your profit. So for example, if I was bearish on a stock, meaning I'm hoping the price actually goes down in the short term, what I can do is I could short, let's say 100 shares of that stock. I initially borrow those 100 shares from my broker. I then immediately sell them in the market. Let's say the current market price is 50 bucks. So I sell 100 shares immediately at a price of 50 bucks per share, which then allows me to take in $5,000, right? Because since I'm initially selling something in the market, I should be taking in money. So selling 100 shares of a stock trading at 50 bucks per share, that's $5,000 that I take in initially. And now let's say fast forwarding maybe a week or two, and I'm correct in my assumption, and the price actually drops from 50 down to, let's say, 40 bucks per share. And so now in this case, I will have to buy back those 100 shares. If I'm now buying 100 shares at a price of 40 bucks per share, that's going to cost $4,000. And so if I've already taken in $5,000 initially, well, I can take 4,000 of that and use it to buy back those 100 shares, return them to my broker, and then what's left is my $1,000 profit. Now my broker may also require some interest for the time that I was borrowing those shares, so my full in the end profit may not be exactly $1,000, but just for the sake of making this example easy, let's just say that my profit in the end of this little example here is that full $1,000. And so then you can imagine that if I was wrong in my assumption and the stock price actually increased from 50 to let's say 60 bucks per share, well now I'm going to be losing money. And that's because I will eventually have to buy back those 100 shares. And if the price is now 60 bucks per share, then buying back 100 shares is going to cost $6,000. But I only have $5,000 that I've taken in initially. So I will have to use that $5,000 plus an extra $1,000 from my own pocket to buy back those 100 shares so I can return them to my broker. So in that case, I would have lost $1,000. And this is the exact situation where using a call option would prevent that kind of loss from occurring. And so specifically with call options, right, these are just contracts like put options between the buyer and the seller of the contract. And this contract does have an expiration date, right? All options do have an expiration date. And so just like any other form of insurance, car insurance, for example, you'll have to continually pay money to buy more contracts after the ones that you have expire to maintain your coverage or your protection basically. And call options have a strike price, same as put options. And the strike price is going to be the actual price at which the buyer and the seller of that contract are going to trade or exchange 100 shares of whichever stock the contract is tied to by the expiration date. But that's only going to happen if it's actually going to be advantageous to do so for the option buyer, for the purchaser of that stock insurance. So essentially that means only in the cases where the option buyer is losing money on their stock position, in those situations only, they would actually need to use their stock insurance to recuperate their losses. And so this is where the main distinction between call options and put options come into play. Because with put options, the strike price essentially means that this is the price where the option buyer has the right or the option to sell 100 shares to the person who's sold them that contract. Whereas with call options, the strike price means the option buyer, the purchaser of that particular kind of stock insurance, has the right or the option to buy 100 shares of that stock at the strike price. And that is a very key distinction between these two different kinds of options. Put options give the buyer the right to sell their shares, whereas the call option buyer has the right to purchase 100 shares. And perhaps if you're kind of thinking ahead here, this should make sense in regards to short selling, because with short selling, you initially sell 100 shares to get into that position, and then to close out for either a profit or a loss, you have to buy those shares back. So using a call option, which gives you the right to buy shares back at a specific price, is what's going to allow you to potentially recuperate your losses on a short stock position. And so now to make this a lot more concrete, we're going to hop over to my computer and I'll walk you through some detailed examples with my trading platform. All right, welcome to my trading platform here. This is the ThinkOrSwim trading platform owned by TD Ameritrade. And just like my examples in my What Are Put Options video, this is once again a 1-year price action chart of the company American Airlines. And this is one of the stocks that was hardest hit by the coronavirus pandemic back in February and March of 2020 when the market crashed. It still has a long way to go to actually recover back to the price levels before the crash happened. But perhaps, maybe at least for the short term, I am still bearish on this stock. Maybe I think this downtrend here is going to continue for some time going into the future. And so as a result, I may want to short this stock. And so you can see right now the stock price is $15.76 per share. But just to make the math a bit easier in my examples, let's just say, rounding up, I was able to short 100 shares of American Airlines at a price of $16 exactly per share. So again, just as a reminder, that means I technically borrowed 100 shares of stock from my broker here, and then I immediately sold those 100 shares in the market for a price of 16 bucks per share, which means I take in initially $1,600. And so now, of course, I'm hoping that going forward that the stock price continues to decline. But in the event that I am wrong, I want to maybe protect myself from actually losing money if the stock price actually rebounds and continues much higher. And so naturally, this is a perfect situation where I would want to use a call option or some stock insurance to help recuperate my losses if I were to actually incur some. So now I can go to the trade tab here, and right here, this is the option chain for American Airlines, and all the options are sorted in these tabs based on their expiration date. And so let's say I want to be in this short stock position for maybe 1 month max. And so in this case, I would want to buy insurance that would cover that full month. And so looking at these contracts right here that expire on February 19th, which as of the time of this recording, these options expire in 32 days, basically exactly 1 full month. So these are the options, these are the call options that I would want to buy in this example. So I'll unfold this tab here. And so on the left-hand side here, this whole big column, these are all the individual different call options that I could be buying. And then on the right-hand side here, these are all the different put options. And down this column right here, these are all the different strike prices of all these different calls and puts that I could be buying. So you can see there's a whole spectrum of expiration dates you can choose. And within a specific expiration cycle, there's a whole spectrum of strike prices that you can choose. And remember, the strike price here is the price at which, by the expiration date, I, as the option buyer, the call option buyer specifically, have the right to purchase 100 shares of American Airlines stock. And so this means if I initially shorted 100 shares of American Airlines at a price of 16 bucks per share, then in order to fully protect myself, I would want to buy a call option with a strike of exactly $16. And so now once I've done this, and fast forwarding a bit all the way until expiration, let's say I'm actually totally wrong in my assumption, and American Airlines actually rallies from 16, which is where I shorted it, all the way up to 20 bucks per share. So if we just look at my stock position by itself, ignoring the option here for a second, if I initially shorted 100 shares at a price of 16, and then I have to go out and buy them back at a price of 20, that's going to be a loss of $4 per share times the 100 shares. That's a loss of $400, right? Because when I sold them, I take in $1,600, and then to buy them back at 20, I need $2,000 to do that. But if I only have 1,600, that extra 400 bucks has to come from my own pocket. But now, if we factor in the call option that I bought right after I shorted these shares in the first place, this call option gives me the right to buy back these 100 shares at a price of 16, which is the exact price I sold them to begin with. So even though by expiration the stock is all the way up at 20, I still have the right to buy them back at a price of only 16. And if I sold them first at a price of 16 and I buy them back at a price of 16, I don't lose any money, at least on the stock position. The only money I lose is the money I use to pay to buy this call option. And that is just the consequence of actually using insurance. Car insurance is not free. You have to pay your car insurance company every month or every 3 months, whatever your payment schedule is like. And stock insurance is no different. You have to pay money up front to buy this contract, which does only last for a certain period of time. But once I've done that, for the next 32 days, I do have full protection. And if by expiration day, if I still wanted to hold this short stock position on American Airlines, and I also wanted to continue my coverage, my protection, well, then I could just buy another call option that expires in another 30 days, and that would be the same thing or very analogous to just paying my next installment to my car insurance company. And just to point out here, you can see the bid price for this call option is $115 and the asking price is $118. So going right in between, the fair price for buying or selling this call option would be right around $116 or $117. And just as a side note here, you will see that these numbers are quoted on a per share basis. So that's why you see 1.15 and 1.18, not 115 and 118. This is just how option prices are quoted on a per share basis. But since each contract is tied to 100 shares, you have to multiply these prices by 100. So for the price of about 116 bucks, in this example, I get to save myself from facing a $400 loss. And then in the case where I'm actually correct in my assumption, and if I shorted stock at 16, and let's say by the expiration date, the stock price actually drops to maybe 12 bucks per share, then in this case, I would make $400 on just my stock position, right? Because if I sold at 16 and I get to buy them back at only 12, that's a profit of 4 bucks per share, or 400 bucks for the full 100 shares. And this call option here simply expires worthless, it disappears and goes away. And I mentioned this in my What Are Put Options video, and I'll talk about it again here, but there's always going to be a winner and a loser when it comes to trading options. In the case where the stock price actually rallied from 16 to 20 bucks per share, and I as the call option buyer wanted to use my stock insurance to recuperate those losses, well in this case, that 400 bucks of loss that I have now recuperated from my option, that has to come from somewhere. That 400 bucks cannot just be spontaneously created, it has to come from, in this case, the option seller, the person who sold me that contract in the first place. They're the one who actually loses that 400 bucks. And let's think about why here for a second. If a call option gives me as the buyer of the contract the right to purchase 100 shares at the strike price, who am I buying those shares from? I'm buying them from the person who sold me that contract. the option seller is the one who actually has to sell me those 100 shares at a price of 16. Now, if by the expiration day, if the stock is all the way at 20 bucks per share, then of course, I as the option buyer am going to want to use my stock insurance to cover my losses. So I'm going to buy my 100 shares from the option seller. But if the option seller does not currently have those 100 shares in their portfolio at that time, well, they're going to have to go into the market and buy 100 shares and then sell them to me. They are obligated, they must sell me those 100 shares at a price of 16. And so if on the expiration day, if the price is all the way at 20, the option seller is going to have to go into the market, buy 100 shares at a price of 20 bucks per share, and then immediately turn around and sell them to me at a price of only 16 bucks per share. So from the option seller's perspective, if they buy at 20 and sell at only 16, that is a loss of 4 bucks per share times 100 shares. That's a loss of $400. And so that proves my point. That 400 bucks has to come from somewhere, and in this case, it comes from the option seller. Now, if the option seller already had those 100 shares to begin with, then depending on where that option seller initially bought those 100 shares in the first place, that person may or may not actually lose money in the end. But for example, as an option seller myself, whenever I do sell call options, I almost never actually already have the stock in my portfolio. And I would imagine this is the case for a lot of other option sellers as well. And then conversely, in the opposite scenario where the stock price actually decreased, and therefore I, as the option buyer, did not need my stock insurance, well, in that case, I have literally just lit 116 bucks on fire because this option is going to expire worthless, it will disappear, and I will never get this 116 bucks back. That sum of money goes directly to the option seller, and they get to keep that and simply walk away. So focusing just on the option here, there's always going to be somebody on one side of the trade who's going to lose money, and one person who's always going to make money. And it could be either the seller or the buyer of that contract. It just depends on where the stock price actually ends up by the expiration date. All right, so that concludes this video. Thank you so much for watching. And again, if you are interested in learning on a very in-depth level about options trading, and stock market investing, please check out my SKILLSHARE courses. Links in the description of this video. And lastly, if you enjoyed this video, please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. And make sure those notifications are turned on. I'm going to be uploading videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.